It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, the bond market. We've seen increased volatility in the rates market recently as investors are reevaluating expectations for 2024 Federal Reserve rate cuts due to a strong U.S. economy and central bank resistance. Anticipation of easing triggered a rally in stocks and bonds last year, but doubts have arisen about the timing and pace of rate cuts. Expectations that the Fed would begin cutting benchmark interest rates have driven stock prices to all-time highs, but along with those highs has come heightened valuations, with the S&P 500 index trading at 25 times trailing earnings and 20 times forward earnings. Volatility in the rates market has been relatively elevated following some Fed officials suggesting the need for more evidence of sustained inflation before easing, leading to a notable drop in March rate cut expectations from 81% to 47.4% at the time of this writing. Sovereign bond yields globally returned to pre-December levels, marking a reversal in certain markets post-Fed Chair Powell's hint at rate cuts. The initial global bond rally was fueled by expectations of up to 6 2024 rate cuts, conflicting with official projections of only 3. Now, rate cuts show the strongest chance of a first rate cut in May, pushed back from March. As a result, some asset classes, like small-cap stocks, saw reversals with the Russell 2000 declining by 2.5%. Treasury yields, rallying in late 2023, aided Treasuries in avoiding a third consecutive year of losses. Number 2, the employment situation. Despite a rise in Americans filing jobless benefits last week, layoffs remain historically low amid elevated interest rates and recent job cuts in the media and technology sectors. Unemployment benefit applications increased to 214,000 for the week ending January 20th, up by 25,000 from the previous week. The 4-week moving average of claims, a less volatile measure, fell to 202,250. Layoffs, though low, have seen an uptick in the first month of the year, especially in technology and media, with companies like eBay, Google, TikTok, and Amazon announcing job cuts. The Federal Reserve's efforts to control inflation through rate hikes have not significantly impacted the job market, which has remained resilient despite earlier recession predictions, but concerns remain. Overall, 1.83 million Americans were collecting jobless benefits during the week ending January 13th. In the first few weeks of the new year, big tech companies have laid off thousands of employees, prompting concerns about broader economic implications. The tech sector alone has experienced around 8,000 job cuts so far in 2024, driven by a staff reevaluation amid slower post-pandemic sales. Analysts attribute the layoffs to the rise of artificial intelligence and persistent high interest rates. Some experts suggest the tech layoffs may signal future job cuts in other sectors, and a simple web search for layoffs provides support for this notion. Number 3, S&P 500 earnings. More than 60% of S&P 500 stocks will report their latest quarterly results in February, making it the biggest month of earnings in the first quarter. Even more important, some of the largest constituents of the S&P 500 and members of the Magnificent Seven will report results on February 1st. If you're not familiar with earnings season, you could think of it as report card time for public companies. Companies' earnings are a key driver of their stock price, and earnings for the S&P 500 overall are a driver for broader market moves. Aside from reporting results for the most recent quarter, management will also prognosticate on future business and economic conditions as well, which in aggregate can provide investors with key information in making predictions about how a company and the economy might perform in the near future. So far for the fourth quarter of 2023, roughly a third of S&P 500 companies have reported results, and on a blended year-over-year basis, earnings have declined more than 7%. If S&P 500 earnings growth remains in negative territory for the fourth quarter, it will mark the 4th time in the past 5 quarters that earnings growth has been negative. On December 31st, the estimated year-over-year earnings growth rate for the S&P 500 for the fourth quarter was 1.5%. Thus far, 7 of the 11 sectors are reporting year-over-year earnings growth, led by the communication services, utilities, consumer discretionary, and information technology sectors. On the other hand, 4 sectors are reporting a year-over-year decline in earnings: energy, materials, healthcare, and financials. And that has been your Market Minute for the month of February. Thanks for listening.